JBlog, 29th of November 2009. Starting out today looking at gold, actually the gold ETF, uh, the one that holds real gold. Compared to, there's also an ETF out there that holds gold futures that is doubled, but this is just a single. There's physical gold backing up this one. So gold has definitely had an amazing run up in the last, this is a 5-year chart, and in the last 5 years we went, this is $10, 1/10 of an ounce. um, so going from $450 and having a spike here in 2006 and having another spike here in 2008, then dropped below to 650, and now it is 1,150. It was close to 1,200 on the actual metal last week. Definitely an amazing run up. Now if we do compare that to silver over the last 5 years, silver has behaved very differently in that silver reached a high here and has not surpassed that high compared to gold. So it's a different animal, even though silver bugs will always call silver the poor man's gold, and in a way it is. In other ways it isn't, because silver is still an industrial metal where gold has very little industrial use. It is decorative and it is monetary basis. Now, so going back to the actual gold metal, this is what happened over the last 6 months. This is a 6-month chart comparing that to oil. Oil has gone higher, but it has not gone higher in the last month and a half. Actually, it's dropped off. Comparing that to natural gas, natural gas had a bit of a bump on Friday, but is trading generally lower. Gasoline trading lower. Gold we've looked at. Silver slightly higher, but definitely not the parabolic move that gold has. And then copper, again slightly higher, has made a new high here and a new high here, but definitely again not that parabolic blowout that gold seems to have. So there's definitely more to the rise in gold than just a monetary, because if it was just a deterioration of the US dollar, then all of the commodities should go up at the same rate, or roughly the same rate, but gold is definitely outperforming all the other ones. Here's the S&P 500 daily chart. Friday saw a drop on the Dubai issue. Now the Dubai debt seems to be held mostly by European banks. US banks are not that exposed to it yet. The question is, how exposed are the US banks to those European banks which are exposed to Dubai? And that will take several days or weeks or even months to play through. Fact is, the banking sector has been weak. The banking sector has definitely been hit, and one of the ones that has been hit hard is both Goldman Sachs as well as Morgan Stanley. Goldman Sachs has broken to the downside, definitely showing on exponential moving average 1030 has been bearish since the end of October, and has been making lower highs and has now made a lower low. If this lower low keeps in place, this Goldman Sachs is definitely, the market is telling us that Goldman Sachs is in trouble or overpriced or something. The market says it doesn't want any part of it. Here's Morgan Stanley. Again, the market is saying it does not want any part of this. It just had its 1030 crossover. The Bank of America has had the same thing, bearish chart on that. Citicorp, again, same chart. JP Morgan, um, same chart. All the banks are basically not doing too well. Looking at the S&P financial sub-index, again we have the same picture here, not quite as bearish, but generally um, certainly not particularly bullish. So we'll see how that will affect stocks going forward from here. There are some other things that were affected on Friday. Again, the general markets weren't really that affected. Here's the New York composite. Um, Again, RSI still making lower highs, and the price chart is basically stayed flat now. Sooner or later, if we don't get a higher high here, bulls will start deserting this market, simply because if there is no higher highs to be found anywhere, then what's the point of taking the risk? Volume is also dropping off. That might be related to the Thanksgiving holiday in the United States. Stochastics is showing that it has broken below this 80. Generally, from a technical point of view, all this does not look particularly strong, and again, it will depend on whether banks and federal institutions can continue pumping money into the market. Something quite interesting I found out the other day. When GDP is calculated, it's calculated out of several pieces like private spending and investments and imports and exports and blah blah blah. And the interesting thing there is that government spending is part of GDP, but government borrowing is not part of GDP. So when you calculate GDP, you don't include any government borrowing. So from that point of view, the US government can just come along and borrow, let's say, $12.5 trillion and dump it into the market, and that GDP then looks really, really rosy. There's $12.5 trillion of economic activity, because hey, we never have to pay this money back, right? But of course that's not how it works. Now next year and the year after that, interest payments on the US debt will start coming up. So there's two options to cover those interest payments. That is either to borrow more money to pay the interest, or to raise taxes and raise other levies to come up with what will amount to about $200 billion every year and going up from there. That will drain money from the economy, and that will be extremely bearish, on top of baby boomers retiring, Medicare and Medicaid spending, and ongoing never-ending war, and all the other things that the government has committed itself to doing. So again, under the circumstances, fundamentally, I still do not see a reason why we're going back to the pre-2007 stock market. I do not see the future particularly rosy for the next little while. I do long term, because I believe we will solve many of our problems eventually, probably in the next 10 to 15 years. But short term, this market needs to correct. Things need to come down into back into a range where things make sense, and I believe the market is starting to tell us that. Here's the financial triple that I have. Here's the Goldman Sachs that I've got short. Generally things are going my way. I'm quite happy. I hope things are working out for you as well. I hope you're not being hit by this. My 10 minutes up, so I gotta go. All the best, and hope you make lots of money next week. Bye.